The reality is you really only need to master three things to win consistently when it comes to the Forex market. However, while there is only three things that you need to master, you do need to master all three. And in today's video, I'm going to be going over these three things so you know what to develop and work on so you can start getting those consistent wins that you're looking for. In fact, at the end of the video, I'm going to be putting all this stuff together and show you an example on the charts so you can actually see this stuff working in action. However, before I get to the good stuff, I need to ask you guys a favor.
You naughty, naughty. You teasing me, you naughty, naughty.
There's a little like button towards the bottom of the video, and if you click on it and turn it blue, it'll help spread this video out to other traders just like you who are also on their journey to achieve their goals with the Forex market. So if you aren't subscribed to the channel yet, definitely go ahead and do that because we push out content like this multiple times a week. With that said, let's go ahead and roll the intro. Okay, so we know we need to master three things in order to find consistent wins, and we must master all three. And I'm gonna tell you these three in a very specific order because you must master them in a very specific order as well. So let's talk about the first one. The first one is you must know and understand which direction you should be trading when it comes to the Forex market. The beautiful thing is about the Forex market is the fact that since we're trading various different conversion currency exchange rates, we can trade whether the market is going up or whether the market is going down. Whereas traditional stocks, most people usually for stocks, they have a general tendency to end up wanting to buy low to eventually sell high later, right?
Stocks only go up.
And that type of trading method falls apart if there's something bad happening with the economy. Why? Because the stocks end up crashing and people are so used to trading going in the long direction, buying low, selling high, looking to buy and hold and trade upwards, that those type of strategies end up not working. They break apart when there's something wrong with the economy. Now, in terms of the Forex market, since we're trading the currency fluctuation of exchange rate, we do trades that go up or down. It doesn't matter. In fact, half of my trades are going in the sell direction, going short, going downwards, whereas the other half of my trades are going long in the up direction. I don't have any general tendency to look for trades that are only going in the up direction or only going in the down direction. I'll give you an example. This right here is a chart of USD CAD. If you look at it, I am currently on the time frame of the weekly time frame, right? Meaning each of these little bars, each of these little candles, this represents 1 week of time, right? This 1 week, 1 week, 1 week, it's all just 1 week, right? So I've gone on this time frame to show you specifically. If I kind of zoom out and show you the whole history of USD CAD, you'll notice that it's literally been going up, down, up, down, up, down. There's no general trend in any direction that it's going. And this is a beautiful thing about the Forex market because it doesn't matter what's happening in the economy. We know we're able to make money either way, whether we're trading upwards or whether we're trading downwards. So this history goes all the way back until 1994, all the way to 2021 where we are right now. So you'll notice we don't have a general tendency to trade in one direction. However, now we need to figure out which direction do we trade. So just to give you an example, let's kind of just zoom in. You'll notice I'm just going from 2016 all the way to today, right? And I'm going to get this little ruler tool to show you that this market, from this date, it was trending downwards for 98 days. This was a 100-day trend going in the down direction. And then from here up to here, the market has been trending upwards for 385 days, a little bit over a year. And then that same market has been trending downwards for 126 days. And that same market has been trending upwards for 931 days. That's basically 3 years that it's been trending in one direction going up. And then ever since the pandemic happened back in 2020, last year, you'll notice the US dollar has been dramatically dropping downwards. So this currency pair has been trending downwards for the past a little bit over a year, 392 days thus far. So understanding which direction you should trade allows you to, number one, find those entries that you're looking for, and allows you to trade in the same direction that the trend is going so you don't get stopped out. Now that you can clearly see that trends are formed, now we need to figure out how do we determine and how do we interpret whenever a trend is being formed. There are a few ways. My favorite way, the most accurate way you can determine which direction you should be trading is by using fundamentals. What's this? That's fundamental analysis. It's using what's going on in the economies around us, in the world around us, to understand and determine which direction we should be trading most likely. And you'll notice the currency pair that we're looking at is USD CAD, right? So we need to understand what's going on in the United States economy versus the Canadian economy and see which direction it would be going based on the external factors that's going on in the country, in the countries around us. So what are these external factors, right? What fundamental analysis do we need to take into consideration when we're determining which direction we should be trading? Number one, we need to be understanding the economic data of what's happening in that country. This means something like the unemployment or the GDP, what the numbers of an economy are, how the country itself is doing. And another thing we need to look at is the central bank decisions, right? We need to understand whether the central bank is going to give rate hikes or rate cuts, all these different various factors that the central bank itself is going to be making decisions on. And the next thing we need to take into consideration are just like the geopolitical events and news that are happening around us. And what is this? This is just like the stuff that you see on the news, right? This is just like wars happening because of like oil or like weapons or even like the pandemic. And for those of you that live in the UK, this is like Brexit, right? These are just like the main headlines that's happening in the world around us that can dramatically shift how we live our day-to-day lives. And if you take all those into consideration, you'll be able to quickly understand which direction a trend could potentially be forming the quickest way. So that's the first way. Another way to look at and understand which direction that the trend could be trading is to look at various technical factors. These could be looking at what's called like the highs. Are the highs getting lower? Yes, they are. Are the lows getting lower? Yes, they are. Being able to look at that and put that into consideration, you'll notice that's also another way to look at a trend as well. However, this is a little bit slower than just understanding and being able to master what's going on in the economy around us. And the next way that people can generally look at trends is using indicators. Things like the moving average, right? People say, okay, let's just wait until the price goes below like a moving average, and that way you'll know that the trend has most likely formed. I don't prefer that way as much, specifically because if this was a little bit slower to understand where the trend is going, the indicators are a lot slower than finding out the lower highs or lower lows as well. Why? Because whenever we're looking at an indicator, indicators use previous historical data to be able to form those lines that you see on a chart themselves. So these indicators are what's called lagging indicators, where they give you the signal and they show you that the trend is going in the down direction a little bit later than is ideal for most people. However, a lot of new traders tend to go with just indicators simply because it's a very easy way to kind of look at a trend without having to do much thinking, right? So it doesn't matter. Either way that you choose to determine which direction a trend is going, once you can figure out and determine your trend, now it's time to move on to step two. What is step two? Step two is to look at your specific entry. Now, for most traders, they use technical analysis to be able to understand where exactly they should be looking to find their entry on a specific trade. So once you know which direction, now we use technical analysis to determine where exactly we should be entering into the market. So a couple ways to find these entries is, number one, being able to use the same thing as I mentioned before, indicators. So there are different ways to use indicators, and there's many indicators. There's like the Bollinger Bands or the Ichimoku cloud. It doesn't matter which indicator that you're using. A lot of traders have a specific plan, have a specific strategy that they formed that allow them to get entries that are ideal for them and their trading style. Another technical analysis style to find entries is using what's called price action, right? This is literally looking at visually the charts themselves, seeing what the candles and patterns are being formed on the actual charts, not really relying on indicators too much, and being able to figure out and determine where you should be entering your trade that gives you that highest probability entry, the highest probability setup in order for the trade to go in your favor. Now, on this channel, in my previous videos, I've given you plenty of examples on what you can kind of do to look for entries based on technical analysis. I'll just give you like a quick little example that I've given in one of my videos, is just to see which direction that the trend is going. You notice that the trend is going downwards. You just draw a quick little trend line, and whenever the price slowly starts approaching the trend line, you will look for an area to potentially enter your trade going in the direction that the actual trend is going itself. So that's one way to look for a specific entry using technical analysis. Now, most traders, whenever they're looking to enter into a trade, they are wanting to find an entry point where they get as least of drawdown as possible. What do I mean by drawdown? Let's just assume that you entered a trade, let's just say hypothetically over here, looking to trade downwards, right? Let's say you're looking to trade down because you notice the trend is going downwards, but let's just say you entered here, right? In this case, you'll notice, had you entered here, the price went against you by around 99 pips. The price went against you by around 100 pips from here to back here. This is not necessarily an ideal entry because the price did end up swinging towards the loss, towards the negative area. So let's just say you had your stop loss, somewhere above here, somewhere conservative, but still this wouldn't have been as too of an ideal of an entry because the price did end up going against you quite a bit, right? So traders like to look for ideal entries where they get as least amount of drawdown as possible, which would be something similar to this, because in this case, if the price is going against you, let's just say the price did end up going against you a little bit, but in this case, it only went against you by 48 pips before continuing in your favor at around how many ever pips you want to take your profit. Let's say you took your profit right over here at 287 pips. Now this entry would be ideal because you don't have to sit in the negative, in the loss for as long. Now to recap, the two technical analysis ways people find entries are number one, using indicators, or number two, using price action to determine where they should find their entries. Now that you know which direction you should be trading, and now that you know where you should enter into the market, now it's time to figure out where you should actually exit. This is just as important as the entry, if not even more important, because if you have a good entry, but you don't know where to exit, the price could end up going $4,000 in profit in your favor. And then if you don't exit the trade, the price can literally just start going back against you, and you'll see that the $4,000 profit is dwindling down to $3,000, $2,000, $1,000, $900, $800, $400, and you end up going back to break even. And you end up just closing your trade with $0 profit simply because you didn't have a take profit strategy. You didn't have a strategy to find your exit whenever you enter the trade. So this is number three. There are a few ways you can go about finding your exit. Some of the more popular ways to find an exit whenever you're in a trade are using various different techniques. The first one is the same exact thing as I mentioned before, is just using indicators. Most people tend to use the same indicators as they use to enter a trade. They use the same indicators to also exit. Other technical analysis indicator-based traders use other indicators to exit. It all just depends on what you're comfortable with. Another way to exit the trade is to find, using price action, a specific area where you're going to tell yourself that if the price reaches it, I'm just going to take my profits and move on and find the next trade. And another way traders find exits on their trade is using what's called a trailing stop loss, a trailing stop. What is this? This is simply telling your broker, putting a parameter on your broker's platform and telling your broker if the price, as it's continuing down in your favor, let me just go ahead and color this really quickly so you can quickly see it. So it's essentially you telling your broker, if the price is continuing to go down in my favor, I want the stop loss to automatically be moved downwards in profit the farther down the trade moves, right? So your stop loss is just trailing the price action going downwards, and it's going to continue to do so depending on the number of pips that you decided on that stop loss, and it's going to continue to do so indefinitely until the price ends up reversing the amount of pips as you determined for that trailing stop loss, right? So if you determine you want your trailing stop loss to be, let's say, 180 pips, this stop loss will continue to follow the profit all the way downwards, trailing it by 180 pips. And if the price does end up going against you by 180 pips, your trade will automatically stop. This is a very good way for long-term traders to keep their profits running, to try to milk as much of the market as they can. Just notice that sometimes if they do that, there is a bit of an area where they kind of miss out on all this profit because the price had to go against them for the stop loss to be kind of activated. Another way to do the take profit or to find your exit is, as I mentioned before, just using price action, where if you see this potential low here, you can decide to take profit. If the price just ended up reaching this area here, you take your profit, you call it a day, and you move on to find the next entry. And it's very important to understand and be aware of what's going on with the fundamentals, with the news, with the economy around you, because that is also a reason to get out of a trade. If you see that there's a lot of negative news happening in the economy, you don't want to be in that trade if the trend will reverse based on what's happening in the economy. Because I've seen far too many traders go into a trade, they're 40, 50, 60 pips into a trade, but they don't know that there is the non-farm payroll coming out in the next 4 or 5 hours, and they are still in the trade, and then the trade goes literally against them because of the non-farm payroll, and they either get out of the trade and break even, or they just end up losing that trade because they weren't aware of what was going on in the economy. But the main thing I do want to stress is whenever you're in a trade, and I know some of you guys are going to be nodding your head when I say this, is you should not be looking and staring at your charts whenever you enter a trade. And I know many people are guilty of literally staring at the charts whenever they enter the trade because they're either uncertain of their entry or they just have nothing better to do. And if you continue to look at the chart, you're going to start making emotional decisions, and you're not going to let the trade play out to what you had originally planned. Because if you continue to interfere with your trade, you are not letting your strategy do its thing, and you will never ever be able to find out whether that strategy is going to be working for you long term or not. So the main thing I do want to stress is once you're in the trade, allow it to do its thing. Just pay attention to fundamentals, but allow the trade to run its course. Because if you can allow your trades to do their thing for 30, 40, 50, 100 different trades, you can easily tell whether your strategy is going to be profitable over the course of long term. Remember, it is not our goal to get 100% of the trades right. If that is your mentality, you will start having emotional decisions come in place and interfere with your trades, right? You're not going to want to accept a loss, and that's not a healthy emotion to have when it comes to trading. You need to accept your losses, and you need to know that by the end of a series of trades that you're always going to be profiting. Because if you have the mentality that you should always be right, you will always be interfering with your trades, and you will never allow your strategy to run its course. So as long as you can master those three things, the direction, the entry, and the exit, and you must master all three of them, and also in that order as well. But as long as you can slowly develop your trading plan, develop your strategy to take those three things into consideration, you'll notice your profitability when it comes to the Forex market will slowly start increasing little by little until you can slowly grow your account to a point where you are completely satisfied with the amount of monthly income that you're bringing in with your trading. And some of you out there might already have the direction down pat. You might always be on the right side of the trade. You might only need to work on your entry. Others of you might have the direction and the entry. Maybe you need to work on the exit. So as long as you can determine and isolate what you need to work on, you'll know exactly what you need to fix to allow yourself to get to the profitability that you're looking for. So I hope this video was able to help you out and giving you an idea of what I look for whenever I'm looking to enter trades. I'm looking for the direction, the entry, and the exit. And once you get those three things down, you are well on your way. Trade safe, guys. See you guys in the next video.